want to go back to kind of the world economic scene, because that certainly played out in the markets today. Also want to talk about how emerging markets are responding to U.S. monetary policy. We did, or we're going to put that question, I should say, to George Hoguet. He's global investment strategist at State Street Global Advisors right here in Boston. He's also a former World Bank official, and he joins us here. George, great to have you here with us.
Good afternoon.
You know, a lot of things at play in the markets today, but one thing is what we got out of Ireland, that they may be willing to ask for an international bailout. That gave a lot of support to the international markets today. What do you think about what's going on in Ireland? Should investors be enthused that they may be going for a bailout here?
You know, Carol, I think there's going to be an orderly resolution of the Irish situation. It's going to involve a number of parties, probably the IMF, the ECB, and also the Stabilization Fund, which the Europeans set up some months ago.
Right.
But you have to look at this in the context of the Greek situation and where we were in terms of April and March and how long that situation was drawn out. I think the Europeans have learned from this, and this is finally coming to a head.
Should we assume that once Ireland gets taken care of, that Portugal's next, or Spain's next, or Italy? Should we assume that?
Well, I think in capital markets, it's dangerous to make any type of fast and dirty assumption.
But you've got to make investment decisions based on what you think potentially could happen around the globe.
Right. I think the basic decision I would make is that there's not going to be a disorderly shock or sovereign default in the Eurozone, which is going to significantly disrupt the markets. It's true that markets can create their own equilibrium and sort of bring forward the day of reckoning. And as emerging markets investors, we've seen that many times in Turkey, in Argentina, and elsewhere. But I think given the state of the world recovery and what we learned in the crisis, that we're not going to have an unanticipated shock.
Let's talk emerging markets versus developed markets, because as you know, emerging markets have outperformed developed markets by nearly triple the returns. Do you expect that to continue, or is that going to be reined in as countries like China take measures to kind of cool their growth?
Well, let's talk about it in a very long-term time frame and then a short-term time frame. So over the past 10 years, the S&P 500 has basically returned zero.
Right.
And emerging markets have returned about 10%. So that's not going to be true in the next 10 years. But both the cyclical and secular outlook, Carol, I think for emerging markets is superior than developed markets. Just looking 12 months out, the earnings growth rate for emerging markets is about 20-25%, and they're selling at a forward PE of around 11 or 12. Now, that being said, emerging market crises are not a thing of the past. We're still going to have unanticipated shocks in the world economy.
Does that include China? And I think about all the steps that they're taking at this point.
So I can't tell you how many times in the course of my career we've debated the question, will China have a hard landing?
Right.
And now we've got some unanticipated inflation in China, and the markets are concerned about that. The China juggernaut continues unabated. Growth in China next year is going to be 9% versus 2.5% in the U.S.
Right.
Earnings growth in the A-share market is strong.
Is China wrong? We just got about 20 seconds left.
Sure.
George, is China wrong to be kind of mad at the Fed, the central bank, in terms of their policy QE2? Just quickly.
I think that the Chinese comments are understandable from their perspective, but fail to take into account the larger objective conditions in the world economy. China has intervened for years in its exchange rate. We have 9.6% unemployment. We've got to get that down, and quantitative easing is one way to do that.
So a little understanding wouldn't be a bad thing, it sounds like. All right, George, we're going to leave it there. George Hoguet, everybody at State Street Global Advisors joining us here. Thank you, George.